You focus on your studies, work hard, land a solid job, and put in the effort during your career, all with the hope of eventually enjoying a peaceful and relaxing retirement. At least that's the dream, right? But unfortunately, it's not always the reality. There are plenty of examples of individuals with stable jobs and strong savings still having to work into their later years. And this doesn't even account for those who don't have the advantage of higher education or a reliable career to rely on. Recent studies suggest that fewer than 30% of American workers are even on track to retire at all, and an even smaller percentage are confident about enjoying a comfortable retirement. They might be onto something. I understand you weren't expecting to hear this, but there are several huge factors influencing the current world that could keep younger generations working indefinitely. This is even before we consider the long-term impact of the COVID-19 pandemic, which has deepened the divide between younger generations, who often face less wealth and more precarious jobs, and older generations that are generally more financially secure. Now, you might believe you're an exception. Perhaps you're contributing to your 401k, saving consistently, subscribing to resources like How Money Works, and even making regular stock market investments. That's fantastic, but I may still have some unfortunate news for you. A lot is happening behind the scenes. The housing market, the stock market, and a variety of economic conditions could undermine many of the assumptions we have about endless economic growth. It's time to dive deeper into how money works, to understand why most of us will likely be working until we're 120 years old. Housing. Let's start with the most obvious factor, housing. For many people in the US, buying a home has become an increasingly difficult goal. This isn't exactly a new issue, but there are some key factors that aren't always considered. Even top-earning individuals who graduate from prestigious universities and pursue careers in fields like banking or tech often end up moving to high-cost cities such as New York, Chicago, or San Francisco. Recent data from Pew Research shows that a majority of young adults between 18 and 30 are now living at home with their parents. In 2019, the median age for a first-time homebuyer was 34, and experts agree that this age will likely continue to rise due to the pandemic's impact. Furthermore, many young buyers are opting for smaller living spaces, such as apartments or townhouses, rather than traditional detached family homes. Not because they don't want a larger house, but because they simply can't afford one. This is a big deal because, as most financially stable people would tell you, a home is usually their most valuable asset. Owning a home doesn't just mean it's the highest value asset they have. It means they can avoid paying rent, and even if they have a mortgage, their payments are building equity in the property. Plus, once the mortgage is paid off, they have a place to live with very little ongoing cost. If you retire with a paid-off home, even modest retirement savings can stretch much further than for someone who has to continue paying rent. If cash runs low in retirement, a homeowner can downsize their house, a luxury not available to someone who hasn't fully paid off their home or doesn't own one at all. Let's be optimistic and assume the median age of 34 is the average age for buying a first home. Add a 30-year mortgage on top of that, and by the time this person reaches their mid-60s, they're still paying off their mortgage. This assumes they don't upgrade or renovate their home, which could increase their mortgage over time. For the more cynical among you, you might think, well, the boomers will eventually pass on and leave us their homes, right? And sadly, yes. Though unpleasant, it's a likely outcome. However, this might actually make things worse. As we discussed in our video about why family wealth often disappears, inheritances that could help fund a retirement typically go to people who are already wealthy themselves. Now, the unaffordable housing crisis is an issue that's been around for a long time, but what if you're not concerned about owning a home? Maybe you're planning to fund your retirement in other ways, without owning property. Well, let's put that to the test. The stock market. The stock market is another major tool many use to fund retirement. Even pension funds depend on stock market growth to ensure they can pay out to retirees. But this assumption of continual growth might soon face significant challenges. To understand why, let's look at a simple example. Imagine there are 10 lumberjacks working at a sawmill, making frames for homes. They're currently using basic hand tools, but if they all work hard and do their job, they'll meet their quotas. One particularly savvy lumberjack invests part of his paycheck into researching motorized tools. Eventually, he invents the table saw, a tool that can dramatically increase productivity. He then buys materials to build 9 more table saws and gives them to his colleagues, improving their efficiency and helping them meet their quotas, even if he doesn't show up to work. This is a perfect example of capital investment. investing in tools or machinery that increase productivity, allowing workers to produce more with less effort. This is, in theory, how we can sustain funding for retirement. The same amount of output is achieved, but the workers don't have to work harder or longer, and the first lumberjack gets a comfortable retirement for his innovation. In the real world, this plays out similarly. Companies raise funds and invest in capital equipment to make production more efficient, allowing for greater profits and higher wages for workers. But here's where the problem starts. More and more lumberjacks begin to have the same idea. Some invest in forklifts to make tasks easier, others invest in more advanced tools, and eventually the process becomes so automated that the number of workers required is significantly reduced. Replacing workers with capital equipment becomes increasingly expensive, and eventually companies might need to invest millions in robotics just to maintain output levels. At this point, some lumberjacks may decide to simply buy the factory, cut down the workforce, and retire, while the remaining workers are forced to work extra hours. This approach highlights a crucial issue: investment in non-productive assets like gold, Bitcoin, or real estate. Real estate, unlike other non-productive assets, generates income through rent. However, when too much money flows into real estate, it drives up property prices, exacerbating the housing issue and diverting funds away from more productive investments that could help fund retirement. Overinflation of asset markets. Now let's examine the overinflation of all asset markets. Going back to our table saw example, imagine each saw was replaced by a share of stock. Each stock pays a dividend, just like the table saws produced wood. Let's say each stock earns $20 per day in dividends. To fund their retirement, the lumberjack needs 9 stocks, just as he needed 9 table saws. Now, what happens if those stocks become more expensive? Most people assume that rising stock prices are a good thing, but the reality is more complicated. If each stock now costs $10,000, it would take a lumberjack earning $180 per day quite a bit longer to save up enough for retirement. And if those same stocks rise to $100,000 each, our lumberjack is now in a situation where it's practically impossible to afford a comfortable retirement based on his current income. This may sound extreme, but it's exactly what's happening today, especially as the price-to-earnings (PE) ratio of the S&P 500 continues to climb to unsustainable levels. Historically, the average PE ratio has been around 15, meaning it would take about 15 years of earnings to pay for a stock. Currently, it's just under 50, a level that signals the need for much larger investments to fund retirement. The 6 headwinds. The second reason why this scenario is troubling involves a concept explored by economist Robert J. Gordon in his paper, "Is U.S. Economic Growth Over?" Faltering innovation confronts the 6 headwinds. Gordon argues that the past 200 years of economic growth were likely an anomaly. The 6 headwinds he outlines will slow growth for the next century. The loss of the demographic dividend. The massive boost to the workforce caused by women entering the workforce has already occurred, and we won't see this expansion again. The decline in educational attainment. Education is increasingly expensive and irrelevant to today's workforce. Rising inequality. Income growth is concentrated among the top 1%, leaving the majority behind. The impact of globalization. While it benefits some countries, it brings wage stagnation to developed nations. Environmental costs. The reliance on fossil fuels is leading to environmental collapse, which will slow down production. Growing debt. Rising household, government, and corporate debt will eventually need to be addressed, likely through higher taxes or reduced spending. Gordon suggests that the solution to many of these issues could be to delay retirement, a reality we may all have to face. If all of this feels overwhelming and you still believe you'll strike it rich overnight, then more power to you. But until then, it's worth watching our video on what to do if you suddenly come into a lot of money. And remember, step 1 will always be to like and subscribe to our channel.